the healthcare software scandal that fooled everyone. The year was 1999, and Wall Street was drunk on dot-com fever and massive corporate mergers that promised to reshape entire industries. In the healthcare sector, one deal stood above all others as the perfect marriage of old-school pharmaceutical distribution and cutting-edge medical software technology. McKesson Corporation, America's oldest and largest pharmaceutical distributor founded in 1833, announced its acquisition of HBO & Company for $9 billion. HBOC, as it was known, claimed to be the leading provider of healthcare information systems, serving over 4,000 hospitals and healthcare facilities across the nation with sophisticated software that managed everything from patient records to billing systems. The merger created McKesson HBOC, a healthcare giant with combined annual revenues exceeding $30 billion. Financial analysts praised the strategic vision. Investors bid up the stock price by 40% in the months following the announcement, and healthcare industry publications hailed it as a transformative deal that would revolutionize medical technology. But beneath the glossy presentations and soaring stock prices lay one of the most elaborate accounting frauds in corporate history, a scheme so sophisticated it fooled auditors, analysts, investment banks, and even the Securities and Exchange Commission for nearly 2 years. HBO & Company had built its reputation on a foundation of lies that stretched back to 1997, when the pressure to meet Wall Street's relentless growth expectations pushed executives past the boundaries of legal accounting practices. The company's software products were real enough, but the revenues reported to investors were largely fictional, created through a web of fabricated transactions, backdated contracts, and phantom customers that existed only in the imaginations of desperate executives. Charles McCall, HBOC's chairman and chief executive, orchestrated the fraud with military precision, having served as a former Air Force officer before entering the healthcare software business. Under his direction, the company created an entire shadow accounting system that recorded millions of dollars in revenue from software licenses that were never sold, maintenance contracts that were never signed, and training services that were never provided. The scheme was breathtakingly simple in concept, but required extraordinary attention to detail and execution. Sales executives were instructed to create fictitious purchase orders from real hospitals, complete with forged signatures from purchasing managers who had no knowledge of the supposed transactions. The company maintained detailed files on these phantom deals, including fake correspondence between HBOC sales representatives and fictional hospital administrators discussing implementation timelines and payment schedules. The fraud accelerated dramatically in 1998 as HBOC positioned itself for acquisition, with executives understanding that a higher stock price would translate directly into personal wealth through their equity stakes and stock options. The company began recognizing revenue from software deals that wouldn't be completed for months or even years into the future, a practice known as channel stuffing that violated fundamental accounting principles but was difficult for outsiders to detect. HBOC sales teams were instructed to approach existing customers with offers for deeply discounted software upgrades, with payment terms stretched out over multiple years and revenue recognized immediately despite the extended collection periods. The company also engaged in round-trip transactions with business partners where HBOC would purchase consulting services or software components from vendors who would simultaneously purchase HBOC software licenses for equivalent amounts, creating the appearance of legitimate sales while merely shuffling money between bank accounts. Internal emails later obtained by federal investigators revealed that some HBOC executives privately joked about their creative accounting and referred to certain revenue categories as fairy dust that made quarterly numbers magically appear when needed to meet analyst expectations. McKesson's due diligence process, conducted by teams of lawyers, accountants, and investment bankers from prestigious Wall Street firms, somehow failed to detect the massive fraud despite months of investigation and access to HBOC's financial records. The pharmaceutical distributor's executives were so convinced of HBOC's growth potential that they structured the deal with a significant premium, paying nearly twice the software company's annual revenues at a time when even the most successful technology companies rarely commanded valuations above 10 times earnings. PricewaterhouseCoopers, HBOC's auditing firm, had signed off on the company's financial statements for 3 consecutive years without detecting the fraud, despite conducting extensive reviews that included verification of major customer contracts and revenue recognition policies. The auditors later claimed that HBOC executives had deliberately misled them by providing falsified documentation and coordinating elaborate cover-ups that included coaching employees on what to say during audit interviews. Goldman Sachs and Morgan Stanley, the investment banks that advised on the merger and earned over $60 million in fees, conducted their own financial analysis that relied heavily on HBOC's reported revenue figures and growth projections, never suspecting that the underlying data was systematically manipulated. The merged company's troubles began almost immediately after the deal closed in January 1999, when McKesson executives attempted to integrate HBOC's operations with their own pharmaceutical distribution business, and discovered troubling inconsistencies in customer records and revenue recognition practices. Several major hospital systems that HBOC claimed as customers denied having active software contracts with the company, while others reported that their actual spending on HBOC products was significantly lower than what appeared in the software company's internal sales reports. McKesson's chief financial officer, who had been promoted to oversee the combined company's finances, began conducting an internal investigation that uncovered evidence of systematic accounting irregularities dating back more than 2 years. The investigation revealed that HBOC had inflated its revenues by over $500 million during the 3-year period leading up to the merger, representing nearly 20% of the company's reported sales during that time frame. By April 1999, just 3 months after completing the acquisition, McKesson was forced to announce that it had discovered accounting irregularities at HBOC and would be restating financial results for multiple quarters. The Securities and Exchange Commission launched a formal investigation in May 1999, sending teams of enforcement attorneys and forensic accountants to examine HBOC's books and interview current and former employees who might have knowledge of fraudulent activities. The SEC's investigation quickly expanded beyond simple accounting irregularities as investigators uncovered evidence of a deliberate conspiracy to mislead investors, auditors, and potential acquirers about the true state of HBOC's business. Federal prosecutors in the Northern District of California opened a parallel criminal investigation, working closely with FBI agents who specialized in complex financial crimes and had experience unraveling sophisticated accounting frauds. The criminal investigation focused on whether HBOC executives had intentionally deceived McKesson during the merger negotiations, potentially making the fraud a case of securities fraud and wire fraud that could result in significant prison sentences for those involved. As news of the investigations became public, McKesson HBOC's stock price collapsed, losing over 60% of its value in the 6 months following the merger and wiping out more than $18 billion in shareholder wealth. Charles McCall and other senior HBOC executives initially denied any wrongdoing and hired prominent white-collar defense attorneys who argued that any accounting irregularities were the result of honest mistakes rather than intentional fraud. However, the government's case grew stronger as investigators obtained internal HBOC emails and documents that showed clear evidence of deliberate deception, including detailed instructions from senior executives on how to manipulate revenue recognition and hide the fraud from auditors and potential acquirers. In September 2000, federal prosecutors unsealed indictments against McCall and 4 other former HBOC executives, charging them with conspiracy, securities fraud, and mail fraud in connection with the accounting scheme that had artificially inflated the company's value by hundreds of millions of dollars. The indictments alleged that the executives had personally profited by over $40 million through stock sales and bonuses that were based on the fraudulent financial results, while investors and McKesson shareholders had lost billions when the true state of HBOC's business became known. The criminal charges sent shockwaves through the healthcare software industry and prompted congressional hearings on the adequacy of merger due diligence and auditing standards for technology companies. The trials of the HBOC executives began in federal court in San Francisco in early 2001, with prosecutors presenting evidence that included thousands of pages of internal company documents, testimony from former employees who had been pressured to participate in the fraud, and expert analysis showing how the accounting manipulations had systematically deceived investors and potential acquirers. Charles McCall, facing the most serious charges as the alleged mastermind of the scheme, attempted to shift blame to subordinates and claimed that he had relied on the advice of accountants and lawyers who assured him that HBOC's revenue recognition practices were appropriate. However, government prosecutors presented evidence that McCall had personally reviewed and approved many of the fictitious transactions and had been directly involved in efforts to conceal the fraud from McKesson's due diligence teams during the merger negotiations. In June 2001, after a 3-month trial, a federal jury convicted McCall on multiple counts of securities fraud and conspiracy, while 3 other executives were also found guilty of participating in the accounting scheme. The convictions represented one of the largest healthcare fraud prosecutions in federal court history, and established important precedents for holding corporate executives accountable for systematic accounting manipulation. The sentencing of the HBOC executives in late 2001 reflected the serious nature of their crimes and the massive financial harm caused by their actions, with Charles McCall receiving a 10-year federal prison sentence that was among the harshest ever imposed for accounting fraud at that time. The other convicted executives received sentences ranging from 2 to 7 years in federal prison, while also being ordered to pay millions of dollars in restitution to investors who had been harmed by the fraudulent scheme. McKesson Corporation, meanwhile, faced hundreds of millions of dollars in legal costs and settlements with shareholders who sued the company for failing to detect the HBOC fraud during its due diligence process, though the pharmaceutical distributor was ultimately viewed more as a victim than a perpetrator of the scheme. The company was forced to write off over $2 billion related to the HBOC acquisition and spent several years rebuilding its reputation and financial performance after the scandal. The Securities and Exchange Commission imposed additional penalties on McKesson HBOC and required the company to implement enhanced internal controls and financial reporting procedures designed to prevent similar fraud in the future. The scandal also prompted significant changes in merger due diligence practices throughout the corporate world, with investment banks and acquiring companies implementing more rigorous verification procedures for revenue recognition and customer relationships, particularly in the rapidly growing technology sector where accounting practices were often less standardized than in traditional industries.